Hello, everyone, and welcome to the first episode of our series, a quick examination of the quarter gone by and the learnings for the future. I'm Prashant Shukla, Vice President and Lead of the Financial Research Practice at Everest Group, and I'm joined by my colleague Akash Verma.
Hi everyone.
As the name suggests, in this series, we would uncover key insights on the most recent quarterly earnings and what they mean for the services industry in the coming quarters. Today, we would be talking about the September 2021 quarter. Let me set some context. CY 2021 has proven to be not just a good, but a great year for the services industry. The demand bounce back has been from factors beyond just pent up build from the pandemic impacted 2020. We now firmly believe that we are in the beginning of a mega demand upcycle, one which has the potential to drive growth in 2022 and beyond. We found that the September quarter is strongly backing our outlook as we observe robust growth and acceleration. Growth was across all key service lines, geographies, and industries, even the ones which were severely impacted by the pandemic. So, Akash, why don't you share the cool trends we are observing in our data?
Prashant, 2021 has been a great year for IT services industry and the data also shows that growth has bounced back after a few quarters of decline and the recovery this time has been much faster than that during the last crisis, which was GFC. Now coming to the September quarter, growth further improved. Yes, there is a major component of weak base, but even after factoring that out, growth is healthy for the industry and it has already exceeded the pre-pandemic level. Moreover, this growth is sustainable and is set to accelerate, and we have some solid evidence around this. The first indicator is confident outlook that service providers are giving. In September quarter, most providers raised their growth guidance, and these guidance are meaningfully higher than what they were expecting at the beginning of the year. And then we see very strong pipeline and booking trends. As this exhibit shows, book-to-bill ratio of major providers has been floating consistently above 1.1 times, which is meaningfully higher than the pre-pandemic level. There was a minor dip in September quarter, but it was largely because there were some. And beyond confident outlook and strong booking trends, we are seeing confident stance of service providers on demand visibility. And we see that through spike in net headcount addition by major providers, which is at unprecedented levels. This shows the kind of demand these providers are seeing in the market.
All in all, a very strong trend indeed. Now let's switch gears. The industry is facing an unprecedented challenge in fulfilling demand. So let's talk about, the elephant in the room, the ongoing talent challenge. I believe this is not just a short-term issue associated with a global crisis, but a step change in supply landscape. The enterprises and service providers alike are feeling the heat. As you have shown in this chart, net additions are maybe at all-time high, but there's an element of loss of experience at some level. Uh, Attrition of experienced employees is getting filled by freshers, and the learning ramp would increase headwinds.
And also, as data suggests, attrition has spiked in the last 2 quarters and it is much higher than the pre-pandemic level. As you mentioned, the churn is happening more at an experienced level, typically employees with 3 to 6 years of experience. In September quarter, we saw service providers showing deep concerns around elevated attrition level as this comes from fully capturing demand. They're getting more selective at deals as there is low confidence on the supply front. Some service providers are taking remedial steps. Some of them are traditional ones like higher compensation, bonuses, promotions, and some are more creative in nature, like expanding delivery footprints in new geographies to get access to good talent. However, there is a silver lining. As heat of talent shortage is across industries, it is more difficult for enterprises to get access to tech talent. And given service providers large talent pools, outsourcing becomes an attractive option for enterprises. And due to wage inflation, we are seeing service providers renegotiating on existing contracts for pricing hike. These discussions are still in early stages, and we would keep a track on how this unfolds in the coming quarters. but it should help drive growth and protect margin to some extent.
Right. So now let's talk about margins. We all know service provider margins have been under pressure, especially from costs associated with employees and travel. But there are some more notable factors we observed this quarter, a very high utilization level being one.
Yes, Prashant, utilization rates of major providers, which used to be in the range of 84 to 85% before the pandemic, is now at 89 to 90%. While this is driven by multiple factors like high attrition and work from home, current levels are unsustainable and are set to come down, and this can be a major margin headwind.
So this brings us to the end of our first episode. We will be back next quarter with analysis on December 2021 quarter. Thank you.
Thank you.